The US Treasury is sounding the alarm on a massive hidden corner of the financial world that has grown too large to be ignored. As the private credit market surges into the trillions, regulators are no longer just watching from the sidelines. They are stepping in to prevent a potential meltdown that could ripple through the entire global economy. The Treasury Department is currently intensifying its scrutiny of this market, which has ballooned to an estimated value between $2 and $3.5 trillion. Beginning this month and running through early May 26, the Treasury is convening a high-level series of discussions with both domestic and international insurance regulators. This move follows growing concern that risk is within the shadow banking sector, which now accounts roughly for 9% of all corporate borrowing in the US, could spill over into the broader financial system if left unmonitored. While private credit provides a flexible lifeline for companies, its rapid integration into the regulated insurance sector has officials on edge. Moody's, for example, recently estimated that nearly one-third of the $6 trillion in assets held by US life insurers was tied to private credit by the end of 2024. With the total assets under management projected to exceed $4.5 trillion by 2030, regulators are concerned that the sheer scale of the market is outpacing the transparency required to manage a sharp economic downturn. Recent high-profile failures have provided a sobering preview of these vulnerabilities. The bankruptcies of First Brands and the subprime lender Tricolor exposed significant hidden leverage that caught many by surprise. In the case of First Brands, the company reportedly used off-balance sheet structures to obscure over $5 billion in debt, leaving it with an actual leverage ratio closer to 20 times instead of the 5 times that was initially reported. These incidents have raised serious questions about the reliability of private credit ratings and the economic transparency of fair value assessment for assets that do not trade on public exchanges. As investor confidence wavers, the Treasury's upcoming sessions will zero in on specific pressure points, including fund-level borrowing and the use of offshore reinsurance to move risks off primary balance sheets. While the overall default rate for these companies hovered around 4.5% at the end of 2025, redemptions at some large non-traded funds have climbed to 5% of their net asset value. This has forced some funds to gate or limit withdrawals to prevent the run. The goal of these meetings is to establish a clear regulatory framework before these localized liquidity squeezes evolve into a full-scale systemic crisis. The era of unchecked growth in shadow banking may be coming to an end. Now it's the time for investors and fund managers to prioritize transparency and stress test their portfolios against a tightening regulatory landscape. Stay informed as these Treasury meetings unfold and ensure your credit strategies and your assets are built on foundation of clarity and not hidden leverage. Let's follow that, because this may trigger the thing that I have been saying for quite a long time, that is the liquidity issue, the liquidity bubble. So trade safe, take care, bye-bye.